As global tensions escalate and economic headwinds grow stronger, questions are mounting about how these developments will shape the Philippine economy, especially with oil prices on the rise, inflation coming off a downtrend, and the Bangko Sentral cutting interest rates despite ongoing uncertainty. Will surging oil prices and geopolitical shocks derail the easing inflation trend? Could the BSP's rate cut prove premature if external pressures intensify? And how resilient is the Philippine economy in the face of mounting global risks? Joining us now to provide clarity and context is Mr. Diwa Guinigundo, former Deputy Governor of the Bangko Sentral ng Pilipinas. Mr. Guinigundo, thank you for being with us.
Thank you very much for having me here.
Let's start our conversation with domestic pump prices. Diesel is projected to have a huge spike, almost 5 pesos per liter next week, as tensions between Iran and Israel send markets into a tailspin. Now, what's your take on this?
Well, it's possible to see some incipient price pressures building up from increased petroleum prices. And some forecasts even put it at beyond $100 per barrel. In fact, JP Morgan came up with a forecast of as much as $130 to $150 per barrel. Now, next week, we expect as much as over 4 peso adjustment for diesel, which is key to transport inflation. And as such, it's possible to see some upward adjustments in the prices of food and even non-food commodities. However, from my perspective, given the new revised forecast of the BSP of 1.6%, it's not likely that we will see an overshoot of the target of 2 to 4% this year. Of course, when the BSP continues to reduce policy rate beyond what is we may call permissible differential between the BSP policy rate and the U.S. Fed, the peso could suffer some weakening in the next few days.
Yes, so do you think the Philippine inflation rate will increase this month amid the ongoing tensions in the Middle East?
Oh, definitely, to the extent that food prices are also determined by oil price increases or adjustments. Transport per se also responds to increases or the adjustment in oil prices. In fact, many non-food commodities are also reliant and are a function of oil price adjustments. So yes, it is possible to see some price increases, and therefore inflation rate in June may also be affected in the process.
Yeah. Now, the Energy Department has urged the oil industry to implement staggered price adjustments to minimize the shock from the outbreak of the Israel-Iran conflict. Do you think this is a smart move, and is this doable?
Well, to the extent that industry players have the capacity to do that, why not? But it's going to be challenging because right now, the policy is for them to keep 15 days inventory. Now, that may be too short to play around with pricing. And to achieve some cushion for the consumers, one may wish to consider granting subsidy to public transport sector on a time-bound basis, subject to constant monitoring of the Middle East developments. So it may be a wise move, provided the private sector has the space to do it.
Yes. What should the government do to lessen the impact of the Israel-Iran conflict on the Philippines economically for our OFWs and in other areas?
Well, to me, priority number one is to ensure our OFWs and other Filipino residents in the affected areas are evacuated as soon as possible. This is very urgent, for this is no ordinary war. It may involve some other countries, especially the U.S., and some European allies of both the U.S. and Israel. There was an earlier report in your station that the U.S. is contemplating of participating in the next 2 weeks. That could escalate the tension going on between Iran and Israel. Now, we should ensure those evacuated and sent home are either upskilled or reskilled for possible redeployment. And over the long run, we cannot overemphasize the need to strengthen our economy, to keep our people here and offer them opportunities to use their skills and knowledge in the Philippines. In other words, the less OFWs we send abroad, the less exposure to us to such kind of risks.
Right. Now, onto the BSP's rate cut of 25 basis points yesterday, citing a moderate inflation outlook. Was it too aggressive given the tensions in the Middle East and the weakening of the peso, or it should have kept interest rates steady and observed the effects of the conflict first?
I agree with the BSP that they have the space, sufficient space for monetary policy easing. Both the actual inflation reading for the last 5 months, okay, and the actual risk-adjusted forecast for 2025 at just about 1.6, and then for 2026 and 2027 of less than 4%. I think the BSP has sufficient space to ease monetary policy. At the same time, the weak performance of the economy in the first quarter could also make use of lower interest rates. The BSP will just have to keep on monitoring both upside and downside risks so that they will be very nimble to quickly adjust monetary policy as necessary.
Now, final question. Given that the bond market tends to flourish in times of uncertainty, what is your fearless forecast for the bond market this week and for the rest of the year? Do you think it will perform well?
Well, I don't want to be too definitive because it's a risk-on situation. Yes, normally, when times are difficult and the market is volatile, investors tend to flock to fixed income. However, we are also seeing the BSP bringing down the cost of money. So the returns to bonds are not exactly too attractive. Inflation is also very restrained as to encourage greater exposure to fixed income assets. However, to the extent that the Philippine government continues to source its funding from the capital market, from the bond market, that could somehow exert some upward pressure on the yield of government bonds.
Appreciate your insights, sir. Thanks so much for your time.
Thank you very much, too.
Mr. Diwa Guinigundo, former BSP Deputy Governor.